From the morning reading, margin debt grew in March, but not nearly as much as the S&P. The gain in the S&P exceeded the growth in debt by more than 4%, a fairly large difference. Rallies have tended to do better when there was more growth in debt as opposed to less, as it shows increasing risk appetite from investors, as long as it doesn't get out of hand like 2000 and 2007. Traders have been selling tech and buying small caps. The NASDAQ 100 just closed at a 30-day low, while the Russell 2000 closed at a multi-month high just a day ago. It's unusual to see those indices diverge by much, and when we've seen it to this degree in the past, it has led to inconsistent returns in the S&P, but some weakness in the NDX and RTY. Stocks will be heading into May with excessive optimism. The spread between smart money confidence and dumb money confidence is well into extreme territory beyond a negative 25 percentage points. There have been 8 times since '99 that the spread was at least this negative at the end of April. Returns for the May-June period were negative 6 of those 8 times. The only times it managed a gain were in 2003 and 2009, the 2 times stocks were emerging from multi-year bear markets, which it's safe to say is not the case now. Down pressure was heavy on Thursday. For the S&P, down pressure closed above 80% for the 5th time since the February low. Each of the 4 other times, the S&P rose at least 0.25% the next day. As always, we look for changes in patterns, and if buyers don't step in on Friday, that would be one small sign that we've seen an exhaustion in buying interest. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 8:49 p.m. Central Time, and I'm recording this in preparation for tomorrow, the market day of April the 29th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So hopefully you caught on there that I am indeed recording this on the evening before, so I won't have some of the information I normally have, and indeed we'll go to the morning report, and you'll see I blacked out where we would normally review at this point of our market preview the overnight action in each of the key futures markets. So not going to do that. I will comment briefly on what U.S. macroeconomic reports are scheduled for Friday, so we'll still have that from the morning report. And that is core price, the employment cost index, personal spending, Chicago PMI, and the University of Michigan consumer sentiment. So a pretty busy Friday with respect to a number of reports that are coming out. In terms of current market conditions, our volatility has been climbing in the last several days. It wasn't that many days ago we were at a 10 on the short-term VIX. We're now at a 14.55. Skew remains just above the caution threshold of 125. Also, if you look at IV percentiles, we've been maintaining a very low IV percentile despite some recent weakness. The S&P still a 9, the Russell a 12, the NDX or NASDAQ a 17, and Dow a 12. Note that today we put in a negative 1 standard deviation move on all 4 of the broad market indices. And if you look, we've had a pair of those in recent days on both the Dow and the NASDAQ. NASDAQ's been clearly weaker of the 4 indices of late. We can see that when we look here at the charts. Let's go ahead and go there. Here's the S&P charts, and one of the things to keep in mind, we've been talking about this overhead area of resistance, and while we've had this weakness in the last couple trading sessions, we have not yet actually invalidated anything. We've not broken through any significant swing support. That would be on a horizontal basis here, and then on a diagonal basis here. You see the overnight action that started so far, and we're almost at 9 o'clock Central Time, so Asia certainly is open, and we've had some weakness so far. but we've not actually invalidated anything yet. Now, where are we come the Friday morning in the Friday session? Does that come into play? Do we start to challenge the diagonal support and the horizontal support? Do we break those? Do we leave from the phase 4 that we've enjoyed for so long now? That is certainly a bullish phase of the market action. If we break through the diagonal and horizontal support, that will call that into very much in question. So we'll look for a break, a close below those areas to be able to call that into question. Just a probe that is rejected is not necessarily going to invalidate phase 4. Let's go ahead and take a look at YM or Dow futures, and you see very much the same thing going on here as we've been watching on the S&P. NASDAQ, of course, has been significantly weaker, and frankly, you would already have, if we use this as our benchmark index, we would have already said that we have broken both horizontal and diagonal support. That's very clearly deteriorated there. That's on the back of several very large earnings reports, so that's what's going on there. And then let's go look at the Russell. The Russell's been holding up and certainly has not broken any kind of supports as of yet. On the VIX, you see things are starting to heat up. We even got a person's arrow triggering here, and we'll take a look at the futures. Things are starting to perhaps come up here against recent resistance. We'll see if that pops through there. Certainly if the market continues to break down, we'll see the volatility start to pop. And then bonds. Bonds certainly have been calling for a move for the last several sessions now, and actually getting ready to do what we would call a cloud breakout, which would be an entry point for some traders. And then last, we'll take a look at gold. Gold, look at this. Gold, we actually entered in the trading room a gold position on this day right here. So we're very, very pleased with our timing on that. We've broken out on day 1, and so far in the overnight of day 2, are making a run at, really, we've only had just a teeny bit of price action that's higher than where we are right now, and that was just intraday. So very, very strong move by gold being put in ever since we broke through this triangle pattern. We talked about that this was coming into an apex, and the most likely direction that it would break would be bullish because it came into the triangle on a big bullish move. So very, very nice setup going on there. We did that trade in GLD, the ETF for gold. And then let's go ahead and go to our daily report. And we continue to see slowly but surely, and part of the reason we do this every single day is to see these subtle trends and changes. And we continue to see little pieces of deterioration continue to accumulate. We still are in this market trend intermediate term phase opinion, phase 4, price patterns near horizontal resistance. Our primary index in which we're measuring this off of is, of course, the S&P, and we have not broken through any diagonal or horizontal support levels yet to call phase 4 into question. But we're starting to challenge that for sure, and we're watching this very carefully. So that's perhaps a caution, but has not yet happened. In terms of the 3 mechanical market timing signals, we've already had one deteriorate. The IBD uptrend under pressure has been changed for several days now. Accumulation distribution score, a C- on the NASDAQ, so that certainly is a warning. S&P retains a B. GMI index, this will update actually in the morning, but as of right now, to the best of my knowledge, it remains a 5 out of 6, and the buy signal remains in place since 3-2. GMI 2, more sensitive indicator, is only a 3 out of 8, so that certainly is a cautionary level there. In terms of decision point scoreboards, I don't see any changes for today yet, but we've seen this deterioration coming in on the short term, so those certainly continue to give us reason for concern for this current bull move that this is going to hold up and not break down. Has not yet broken down. So we've got to continue to defend that it's bullish until proven otherwise. But we're starting to have a lot of question marks about that statement. Position sizing opinion, no changes from yesterday. 50% on the portfolio. Investor position sizing opinion, and 75 to 100% on the active trader. In terms of the market posture, we have a weak bear now, and the S&P deteriorated with the action from Thursday into an area below 80, so that turns us into weakly bearish, at which point we would not initiate new short-term or intermediate-term bullish trades. So something to keep in mind. We already had this signal by the NASDAQ a couple days ago, and you see this one's been falling hard and fast. It's already down to a 63. Now the most important index falls, and you notice that the Dow is only just barely above that window, or it would have gone red and weak bear status as well. Now, where does this go? Is this just a weak kind of pullback and then the bulls take over? Well, that would probably be the leading expectation at this point, given that we have this strongly bullish sentiment line. Now, it is in the upper reversal zone. That was another one of those weak warnings that we had, but still, the expectation is with that sentiment line being as high as it is, that any kind of bearish movement would be rather subtle and short-lived before the bulls regain. We also, in terms of the strength of the trend, still retain this strong bullish trend up over 80, so keep that in mind. But we have continued to see the warnings stack up, and we've been for several days. We went from level 0 plus to level 1 several days ago, and we certainly feel quite justified thus far as we've continued to see the warnings come in about these risk assessments. Now, I've not changed any of the strategy opinions yet, but certainly while we've not yet broken anything to be able to say we should change these opinions quite of yet, we certainly are starting to see an accumulation of evidence. So in terms of initiation of new bullish swing positions and so forth, you saw the call from here says no new short-term or intermediate-term bullish trades. So that certainly should flavor many of your strategies. You probably are going to be, many of you, precluded from initiating a new trade given that condition. In terms of option income strategies, the VIX is still inside the acceptable window to initiate new positions, but we might be entering a period where we might have larger than normal delta and vega moves. So it's one of those things where you might want to consider a reduction in position sizing. While you might not be shutting down things altogether, you might want to reduce your position size. You might want to be taking strategies that are a bit more bearish in their posture and protective to the downside than you might have taken, say, a week or 2 weeks ago. And these warnings continue to pile up. We see volatility coming in with market and decline warnings, sharp increase warning. That volatility ratio warning we've been talking about has been in warning status for several days, has now officially fired. So that would seem to tell us that volatility should be increasing, which means the equities are probably would be going down. Distribution day count is in warning status as well with both the NASDAQ and the S&P. The VIX phase has been increasing, skew just above the warning status, calling for about a 9% probability of a 2 standard deviation move in the next 30 days. Current 10 days out on the SPX is still below the 40, but you notice it's been creeping up. This was like 33, 34, 37. Now it's at 38. At 40, we call that a warning status. So I don't want to make too much of it yet, but we continue to see the amount of red here increasing in the last several days. In terms of the key intermarket risk aversion indicators, we've got our first one to now roll over as risk off, and a second one has started to roll over but has not yet crossed, but could easily cross with another big weak day. In terms of sentiment, the action today did scrub off some of that short-term sentiment, so it's back down to relatively benign, though the medium term is still relatively high sentiment warning status. Spain and the oil producers ETFs are still in a very high sentiment levels, so you might want to be watching for potential reversal patterns on both of those ETFs. Our combined score from sentiment using the CNN Money Fear and Greed Index, which has 7 fear and greed indicators rolled up into one score, is at a 70. So this has been coming down. You see yesterday 72, a week ago 74. This has been edging down a little bit as we've seen greater weakness coming in, so it's not quite as extreme as it was. In terms of sector specific, and we'll wrap up with this, you'll see the deterioration in the short to intermediate term. There's not a lot of sectors actually now that are holding up strongly bullish in all 3 time frames. If you were to actually look at the charts on some of these, you'd see that some of these, while they say up right now, are just barely above the signal line where they would drop. So things have definitely been deteriorating. So what's holding up? Telecom so far. And interesting enough, a couple high beta areas, energy, financials, industrials, and materials. So we've got several high beta areas that have been holding up relatively well, whereas many of the more defensive areas seemingly have deteriorated. So we'll see where that has been going. We've seen some rotation of late going from those more defensive into those higher beta areas, and it may be that they just, while they've dropped, they haven't dropped far enough to change signals here. And certainly we get a better feel for that down here. So let's take a look at that. So while these higher beta areas were still up on the short term, where was the drops? Well, look at this: information technology, energy, financials, consumer discretionary, industrials, materials, all in the deeper red areas, whereas what's holding up best? Well, consumer staples, actually positive for the day. Utilities, just below scratch, and even telecom, another defensive area typically, certainly held up better than many of the others, though it was down still about 0.75%. So we have some pretty interesting sector rotation that's been going on, but when a day gets ugly, you'll find that those more defensive areas are the ones that are going to start to hold up, and that'll start to show in these market postures if we continue to see weakness. So let's wrap up one more look. Just look back here at the S&P futures. Things continue to come. I was wondering if we're getting close to the line yet, but we certainly have been getting really, really close to challenging some key support areas. So this is going to be what to look for in the morning. If you get up in the morning and you're listening to this and you're down below 2060 on the S&P futures, and certainly down in the 2050 area, then we may be having something that is more significant developing. So watch this area right here very, very carefully. There is some support. It could very easily just come down here and tap this area, bounce, and regain the channel. So don't get too quick to pull the trigger on shorts. But if we break below the 2058 area, the probably around 2063 area, about 4 or 5 points in that area, we break below and we start to accumulate energy and momentum, and we start running at 2050 and below that, then we probably have got something larger in play going on. Okay, so let's wrap this thing up for tonight. And I did want to make a mention about this right here. So obviously, you're watching us on the YouTube channel. You can subscribe to us on the YouTube channel. That is free. And I very much encourage you to do that. The same place where you subscribe, you hit that little button to subscribe, and that'll give you notice that content has been posted, especially, I'm getting ready to move to Montana from Chicago. I may very well start posting this in the evening before on a regular basis. But whenever I post this content, if you want to get notice, you want to subscribe to that YouTube channel and you'll get alert for that. Also, at the same time, we love it if you hit that like button. That gives us a pat in the back and tells us to continue to do this. And certainly we appreciate that, that commentary there. Also, a couple things. You see this little gear button on YouTube. There's two things you want to look for. One, you want to make sure you're playing it back at high def. And if you don't see that little HD, you're probably seeing a more blurry version than you really want to. Hit that little button, get to where it shows high def, and watch this playback in high def. You can also use these other buttons to see full screen buttons, full screen versions of this. And then the last thing I'll mention is that you can also play the video at about 1.5 speed and still follow and understand everything quite well, and yet cut down the time at which it takes to listen to the content. So that's always helpful to be efficient with your time. I get that. So we're going to go ahead and just roll through the rest of this. If you see something that you have of interest, just hit the pause button, go to the hyperlink, and review that for greater depth. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And then, of course, you have the hyperlink down here for the full set of disclosures. We'll see you back here for Monday's market preview on our next broadcast. And in the meantime, good trading.